Today on Forbes, is your money really safe in an FDIC-insured Fintech account? 4 years ago, Lauren Scott was scrolling through TikTok when she saw a video from Ecom Jess, a personal finance influencer with 750,000 followers, promoting Yada Savings, a Fintech app offering a chance to win cash and other prizes on top of regular interest. Scott liked the novel sweepstakes incentive and Yada's lack of fees, along with something way more traditional. Scott, who is 27 years old, says, quote, "It was FDIC insured, which is one of the main things that I looked for because you never know what to trust." Scott and her husband, who live in the Tacoma, Washington suburbs with a 7-year-old daughter, eventually moved all their money to Yada. Now the Scotts are among 200,000 or so Fintech customers, including 85,000 from Yada, who have been denied access to their so-called FDIC-insured accounts since mid-May, following the Chapter 11 bankruptcy of a Fintech intermediary, San Francisco's Synapse Financial Technologies. It's unclear when they'll get access to their money, and even whether they'll get it all back. At a court hearing last Friday, former FDIC Chair Jelena McWilliams, appointed as bankruptcy trustee in the case, said there's a, quote, shortfall between Synapse's records and those of the banks, currently estimated at $65 to $96 million. Significantly, she added that it's looking increasingly likely that this isn't just a case of bad bookkeeping, but a real shortfall, that is, missing money, that existed before the bankruptcy filing and could take time and extensive investigation to sort out. David Schulzinger, a 40-year-old Phoenix insurance adjuster, has been frozen out of the $50,000 Yada account he had built up over 4 years for vacations and unexpected expenses, such as his wife's recent surgery. He says, quote, "Listen, I'm not a PhD in finance, right? I'm not. I'm just an average everyman. It was always advertised as FDIC insured. If I had for a moment thought that it wasn't, I would never have put any money in this account." U.S. Bankruptcy Court Judge Martin R. Barash of the Central District of California, who is presiding over the Synapse case, has seemed equally flabbergasted by the regulatory black hole that the Fintech depositors and their money have been sucked into. The delay in sorting the situation out is all the more jarring when compared to what happened after California regulators shut down Silicon Valley Bank, also known as SVB, on Friday, March 10, 2023. By the following Monday, customers had access to their cash, and federal bank regulators had stated that all deposits would be covered to mitigate the risk of SVB's failure setting off more bank runs. The deposits covered also included those in excess of the normal FDIC insurance limit of $250,000 per depositor. In the Synapse case, the FDIC says it can't act because there hasn't been a bank failure. As it noted in a bulletin issued after the Synapse disaster, quote, "FDIC deposit insurance does not protect against the insolvency or bankruptcy of a non-bank company. In such cases, while consumers may be able to recover some or all of their funds through an insolvency or bankruptcy proceeding, often handled by a court, such recovery may take some time." So do Fintech customers have any of the FDIC protection they thought they did? Turns out what most of them have is what's called, quote, pass-through FDIC insurance, meaning their money is held in an FBO, or for the benefit of, account at the bank, usually mingled with cash from the Fintech's other customers. In the case of a bank failure, the standard depositor insurance applies to FBO funds, provided, the FDIC states, there are clear records showing who owns what. But get this, the bank itself isn't necessarily responsible for maintaining such records. Those records could be maintained instead by a Fintech or an intermediary like Synapse, which functioned as a bridge between Fintech startups and the small banks holding customers' funds, and apparently in some cases, combined funds from multiple Fintechs in each of its FBO accounts. Bottom line, if a bank itself fails and a Fintech or other third party has good records, the Fintech's customers should be able to collect their insured deposits fairly quickly. If a non-bank Fintech, particularly one with deficient records, implodes, all bets are off. Meanwhile, it's difficult, if not impossible, for consumers to discern how responsibly individual Fintechs have set up accounts promising FDIC insurance. For full coverage, check out Emily Mason's piece on Forbes.com. This is Kieran Meadows from Forbes. Thanks for tuning in.